The broadcast is now starting. All attendees are in listen-only mode.
Welcome. Good evening, everyone. I just realized, sorry, my name is Adam Harris. I'll be your presenter this evening. And just checking the sound is coming through good and solid from my side. So let me try that again. Good evening, everyone. Welcome. So I recognize some of the nades. I recognize some of you from the lounge, which is fantastic. And all good. Welcome. Good to have you. Good to have you around. Good to have you here tonight. So, so I'd like this to be as interactive as possible. The topic that I'll be discussing is the benefits of swing trading or end of day trading, depending on which expression you use. And we'll be covering that over, the next 60 minutes. We'll have a look at the charts, and I'll show you a couple of interesting things as well. So I'd like this to be as interactive as possible. So please feel free to ask questions as we go through. And just a quick, I'm just curious because I do recognize some of the names. Just remind me where in the world you're all listening in from. How many of you are listening in, I guess, from outside the UK? That's just something I'm always interested in. And also, let me know a little bit of how your trading journey is going. Do you feel you're progressing? Um, are you finding if you're in the traders lounge? How do you feel that that's are you finding it a useful environment to have access to? Well, of course, Mike, you're still in Malta. And I'm serious. I've made a promise to myself to move this time next year. I need to be at least spending 50% of my time in the Mediterranean, which is to say somewhere in probably Spain. Probably. I have to be. I can't do another winter. I can't do another crappy summer and another winter like we had. And sorry, excuse my language, but that's how you go. All right, so I think what we could do is we can kick off. I do want to keep an eye on the time, and I'd like, as I said, I'd like this to be as interactive as possible. So that also means that there may be questions, and I will answer to the best of my ability. So the first thing I do need to do is just give you an opportunity to read the risk warning and disclaimer. If you are brand new to trading, please feel free to just tell me a little bit about yourself in the questions box. All right, and I'll give you about 5-10 seconds to read this, and then we can actually kick off. So just while I'm giving you an opportunity, there's a question here from Linda. Thank you. What about Cape Town? Look, Cape Town's lovely, and I haven't been out in a few years. In fact, last time I was there was for a wedding about 3-4 years ago. My sister and my nephew are there. And there's a family house in Noordhoek. But the problem, of course, as you know, is the water. I think if I went out there, I'd have to be washing from a bucket. So for the rest of you who don't know, there's a water shortage in Cape Town, which is the first I've ever recalled. And so it's unusual, very unusual to have that. So the thing is that if I want to be based in the Mediterranean, the goal here is my clients. Usually, I'm going to be a London-based trader, and so I do need the ability to get to London within a few hours, and it's about 5 hours door to door. So if I'm staying in the Mediterranean and there's an emergency, I can make it here very quickly, or I can book all my meetings for clients. And then come through and do them. So the goal would be this time next year, as I'm doing, say, 2 weeks there, 2 weeks here, and that would be, I think, the ultimate goal as well. Yeah, I do. I feel for you. I do. So yes, Steve, I saw your comments in the Traders Lounge. I think you're going to find that incredibly powerful. I mean, for those of you interested, my kind of feedback on my colleagues, they're all very, very good traders. You can't. You have to be a good trader to even join, to even get through. For Nick to even trust you to say stuff without him around, you have to be a very good trader. So, but we're not all the same. The thing that I love about How is he's so precise. He's just incredibly precise with his numbers and his levels. So I'm a little bit more flexible, but that's not better or worse. It's just that that's one of the things I admire about How. Simon is incredibly talented with his intraday trading, also very, very, very good. And Tamara is amazing as well with regards to her approaches to everything. So just a lot of really talented individuals. And collectively, the things that we all have in common is we've all learned the ability to read price action from Nick. So you do see it. Once you start to kind of apply it, it starts to come to you. So in other words, now after a while, you start to be able to feel it rather than feeling like you're guessing it. Uh, and then the next thing, and so the other things that we follow through are all consistently agree on is the key levels, the way that we read price action, and maybe the markets that we trade. That's principally the same. Philip is also very good. I don't know if he's in the lounge at this point, but he's phenomenal, especially with his stocks. So in fact, he's probably more experienced specifically with stocks than I am. But I will I'll explain to you the broader approach to that. So I'm going to dive right in. I haven't done an agenda because that doesn't. I realize that I end up speaking so much about the agenda page that I don't really get through to the content. So this is where we're coming from. This is something you're going to hear me use this a lot more as we on the kind of since I've joined Trade with Precision, which is going on over 2 years now. Initially, I was dealing with very simple, basic stuff for people who were new, and everything I had done would focus on the language around that. Interesting enough, I've now kind of progressed a lot as a trader since as well. And so, interesting enough, Paul Harrison, if you don't know of him, Paul Harrison is also in the lounge. And by amazing coincidence, Paul Harrison and I were at school together. He's not in the UK. He's now in South Africa, but he's based out of Australia, I think. And he and I were in boarding school together, so I actually know him quite well. And of course, his surname is very similar to mine. So, and it turned out that he was a stocks trader. So when I came to London and I was learning how to trade, somehow I found out via Facebook or something, he mentioned something and I realized he was a trader, and I got in touch with him, and he'd kind of made his fortune at the time through stock trading. But he is very sociable, loves to interact with people, which you'll detect. And so I think he just messaged me a couple of years ago and said, "Oh, I'm so bored. Have you got anything for me to do?" So that was an introduction to Trade with Precision. So this is how he comes to join us. So he's got a lot of experiences in those areas as well. Why was I going to bring that up? But I think that was just to explain the background there. So, and so because he's talking about a lot of very essential, sort of not introductory, but kind of the foundation stuff. So I've realized that he's taking over from where I was a couple of years ago, and I'm now sort of progressing onto the bigger conceptual stuff as well. And so that's really what I wanted to focus on here is trading more from a business perspective and more from a, which sounds really obvious, but the whole idea here of just getting on with it rather than just the specifics. So what I would hope that all of you get from everyone else is confirmation of application of all the various areas of trading, and then ideally where I will come in is kind of more of a conceptual. Make sure that you're keeping this in mind, or maybe I'll discuss something specifically. So the key criteria that we're going to be covering, that I'm going to be covering and talking about tonight, are all effectively derived from, let's just say, the PLT strategy checklist. Okay, so both strategies, let's call it all the strategies are trend-based strategies. They're really just about different entries into that. And but the concept here will be taken largely from the PLT strategy checklist. And first of all, we're going to be focusing on optimal price action. That is to say, stable price action behavior. So this is what we really want to be looking for. This is what I want to be looking for in the charts, is I'm looking for stability. The behavior of the chart has to feel as though the current price action is stable. So an example of that would be, there are times when a chart goes from ranging and being very erratic, and then it just starts to trend. So in other words, a market can actually go from not really knowing what it wants to do to actually starting to work and function very nicely, and vice versa. It can be trending beautifully, and then it starts to act erratically. And so I've become relatively sensitive to both ways. I can suddenly detect that a market has now started to trend, and it's kind of obvious when you have a lot more faith in what we do. When the price action starts to become orderly, then it's implying that there is actually order entering the market. And the beauty of trading actually is that very good traders who are systematic technical traders are attracted to order. So in other words, that's why when a little bit of order enters, it often then becomes a proper trend, because other trend-based traders or orderly traders start to enter. So the idea for this, and this is the whole reason this presentation, this was the topic that I chose, is that for the last couple of months, I've been predominantly trading end of day. And it's been very, very interesting because I've technically spent less time placing orders, and updating my stop losses and managing the trades per se, but I've still kind of been fussing over the trades, but actually been doing less. I mean, I did not the last 3 months. Let's just call it the last 2 months. I don't know where the time is going, and my returns have been very good. Okay, so my returns have been really, really nice, and it occurred to me that I think that end of day trading is really underappreciated. When you Google learn how to trade, the thing that comes up the most is forex, and that's a buzzword to a large degree, and there are pros and cons to trading it. And it's the same thing, is that often there's this belief of trading the lower time frames. So I push a lot of the higher time frames because I feel that they're underappreciated. So that's where the thinking kind of comes from. So the key criteria we're going to be focusing on is optimal price action. That is to say, stable price action behavior. So we'll go have a look at that. Then we're going to be talking about higher time frame correlation, weekly and monthly. So the reason I say weekly and monthly is that sometimes it's actually enough just to have the weekly in agreement. It depends on the context of the chart in particular, but occasionally you might have the daily and weekly in an uptrend and the monthly in a downtrend. But that doesn't mean that you can't still take a trade. The key thing is really knowing where our levels are and how much room we have for the move that we particularly want to take. Then, of course, we do need to identify our monthly and weekly support resistance levels. We may want to add in the daily ones for sure. But generally speaking, if we're going to be looking at the daily, and this is a very loose general application, if we're going to be looking at the daily, we're more interested in how much potential the weekly has, because that's kind of, we're going to be in that day, we could be in that end of day trade. And when I say, for those of you who maybe are wondering it but not asking it, if I say end of day trade, this could potentially be referring to an entry on the 8-hour or 12-hour time frame. I guess what I'm really kind of focusing on here is entries above the 4-hour time frame. Okay, but they're largely going to be, the decision to take them is usually taken off the daily. So I'm just looking at the questions. Okay, so the question here as well is, Adam, have you been trading Forex recently, or shares more, or indices? And this is the thing, I've actually been doing about 60% of my stuff has been indices and shares, and the rest has been currencies, maybe even more. So I mean, as in, currencies are making up a much smaller part, and I'm going to explain to you why. There is actually a reason why I'm going with this that will make sense to you. There are a lot of, the beauty of, once you get to a point where you realize you can actually make money trading, that doesn't mean that automatically you just pick winning trades. You still always have that constant battle of a trade that got stopped out that was a really good setup, and you're like, why did that happen? And maybe it was an outside candle or something. Or you still have maybe you miss you miss an entry that you've been waiting for. You still have lots of unsatisfying events occur. And but what happens is that at least your belief is now founded, because you've taken enough trades, you've seen it happen, you know that this stuff actually works. Uh, okay, so let me just carry on with this. We'll get to the next page. It'll make a lot more sense. So then we're looking for a small or small to medium-sized candle. The size of the candle is actually quite important, and that's really from a budget perspective. Sometimes our trading accounts are so small that we're really restricted. We cannot trade, maybe we can't trade the daily time frame or the higher time frame. Believe it or not, on the one account that I was trialing, there actually wasn't enough money to trade certain stocks. So I'd get a scan, and the problem is that the price was the way that the tickets are structured, I couldn't place the trade because there just wasn't enough. It would be more than 1% for the account. So that can happen. So the size of the candle can assist with a smaller account. So I'm going to use a 10K account, £10,000 account here as an example. Okay, for that, which includes the stocks as well as the indices. And so small to medium sized candle also really means that I'm not saying exclude, and we can look at candles as well if you want me to be more specific about what qualifies as a small medium sized candle. But it would be somewhere between a small candle and a medium sized candle, effectively. And then actually, I've been using the 50, 20, and 10 moving averages, and not including the 200. So it's very important, please. I'm not trying to shift you away from TWP style. That's not at all the case. Actually, everything in here is is derived is all TWP. The only difference is that I've taken a few things away because I don't require them anymore. My ability to read price action and read the charts is now almost subconscious or muscle memory. It's a lot easier. I read, I could see what price is going to do. I still get the surprising losses, although things were, there's some unpredictability, but I'm almost never wrong about the direction in which the market is going to go. Um, and so I don't require the 200 at this point in time because I can see the momentum of the market, and that's kind of where I'm going with this. So please understand that this is about, as you kind of mature as a trader, you don't need all the different accessories. You can take a few of the things away. But if you were going to train someone from scratch, you'd have to give them more training wheels, more kind of rules and indicators and indications and checklists, so that they have more things that they can learn to read the price action. And then round numbers as well. So there's a couple of these items, these things are quite relevant to what we're doing at this point in time. So then there's another question here: is Forex the best to trade if you only have a small account? No, I don't think so. This is my personal opinion. I believe that the decision to trade something should be based on its likelihood of generating profits, and then there's got to be a way to do it. So the question is, I think I've even traded a stock account with $2,000 in the account, so it should be feasible depending on that. And actually, to be honest, we're gonna talk about these in more detail, but trading the indices is largely more profitable, and we'll talk about why that's the case. So budget shouldn't be a discriminating factor. And actually, I'm gonna kind of say that there's a lot of benefits to not trading currencies. So again, what I'm saying here is I'm not deviating from trade with precision. What I'm doing is giving you more information so that over time you can start to decide where you want to go, or if you want to specialize or do things. I'm reading questions as you type them. Okay, so this is the whole point of this, was really to kind of go ahead and do that. So this is just to indicate to you what the kind of charts look like, just with the 50, 20, and 10, and just kind of looking at the sort of, this is just a daily, weekly, and monthly layout. We're going to have a look at the actual thing. So the keyword of the day for this presentation, and this is something I'm going to be talking a lot more about, is the concept of momentum. Okay, so why is this something that I've latched onto now? Because I've realized that actually everything we do, momentum is the key. And so momentum refers to the weighted direction of price action. All right, so often we don't really realize it when we're learning how to read price action, but actually price is very much telling us where it wants to go. And it's often indicating if it's bullish or bearish, or not really that decisive. And sometimes it hasn't even really started trending, but it's starting to show early signs, sort of green shoots, of the direction which it's actually quite keen to go in. And so momentum is really is what we have is a sense of where price ultimately really would like to go, where it's indicating it wants to do that. And once you kind of start to see that, or not once you kind of start to see it, once you become aware of the momentum, then what happens is you now know the direction which price really wants to go. What you're hoping to do now is just get a good trade out of it. And this is interesting because often we'll see a chart, we'll be able to tell that it's bullish or bearish, but we won't be able to trade it because it might be too choppy. But it doesn't mean, here's an example. My sister will ask me, the one who has, excuse me, excuse me, they have a house in Scotland and they have a house in Cape Town. So she'll often ask me they have to move money between South Africa, for example. Maybe they're going to buy a property, or they've got too much money there and they need to move it back because of the exposure to South African politics or whatever. And so she'll say to me, what's my analysis on the pound against the South African rand? And then I'll go and do an analysis on it. And it is nothing to do with whether I would trade it or not. And sometimes I'll have to go back to her and say there's no clear direction, or I'll say it's at a key level now, we need to see what's going to happen, but it's likely that it's going to reject that level. And then I'll give her a medium term, meaning something like the next 3 to 4 weeks, and something maybe the next 6 months. I'll give her that kind of indication. And that's just through the analysis, but it's also looking at the momentum of the chart. So what we can do then is, and what I do as well, is I focus on the last 3 to 4 candles of the weekly and monthly charts. And I'm going to show you that on a monthly chart just to see how powerful that is. And it's amazing to me. A lot of people think that if they're trading the 15-minute time frame, that the monthly chart has no real relevance to them. But the distance actually, although the time frame seems a lot higher, the distance on the chart is really not. So the um, it's worth it to do it. It's really not a waste of time, even if you want to trade the 1 hour time frame. Looking at the weekly and monthly can actually often be enough. And then what you've got to ask yourself is, does price action or do these candles look like they want to go in a particular direction? And so we often have to ask ourselves certain questions. And the questions are ways of prompting our brains to reach a conclusion. Okay, so I mean, this is an obvious one. So this is an example of bullish momentum. Now, this isn't actually the kind of example I'm talking about, but this chart is clearly bullish, and the reason it's clearly bullish is because we can see the quality of the trend on the monthly, which is here on the bottom right hand side. The quality of the trend itself is very, very stable. It's crisp, it's stable. The moving averages are really a great compass for where the underlying price is going and how stable it is. And then when we look at it on the weekly, it's also very stable, also going in the same direction. It's just ticking over. It's not too overextended. It's kind of running parallel to the moving averages. So it's just a steady buying momentum. And then we can look at the daily. But the point of this overall being that clearly on monthly, weekly, and daily, the momentum is very, very much to the upside. So that's an obvious example, but it's worth also stating what an obvious example looks like. Then the one that I've kind of got here is this example here is crude oil. So I can't remember when it was, 2-3 weeks ago, maybe longer. I did a PP on crude oil looking to break out. And that was really where it was the bullish momentum. That was where the momentum of it wanting to break out to the upside was pretty obvious. So if we look here on the bottom right hand side, we had oil kind of dropping down, and then we had oil. And at this point, I think it was this candle here that price had started to push up. And at that point, it had become clear that I had a low and a high and a higher low. So the low, the high, and the higher low indicates that price is leaning more to the upside potentially than to the downside. And then what had happened was price hadn't yet broken this high. So what was happening was the candle itself looked quite bullish. And although we might have been in week or the first or second week of the monthly candle, even if it's incomplete, can still give us an indication of today what is the monthly, because if it's bullish, it's bullish. So we can actually take a candle a monthly candle that's only 2 weeks, that's only been open for 2 weeks, and we can read something into that. It can give us some potential information. So at the time that looked pretty good. And then also I think at that point the candle on the weekly was looking, there was a nice bullish one here and a nice bullish one here, and it hadn't actually touched that level yet. But then we had the uptrend on the weekly. So all of that collectively at that point in time looked, I've got to see if I can find it somewhere, but it looked quite bullish. So we had all of that happening. And then the daily at that point was over here. I think it was starting to come back. Actually, it hadn't rejected like that, but it was on its way up. It just looked like it was wanting to climb higher. And so that the point of that was that the chart itself was definitely, the question was it looking bearish? And absolutely not. And so that's a silly, it might sound like a silly question, but these are the things you can ask yourself when you're analyzing a chart, to say, well, if someone stuck a gun to my head and I said, does it look bearish? The answer would be no. Because sometimes we look at it from one angle and we go, well, I can't tell. But then when we look at it from the other angle, it polarizes the position, the analysis or the direction. So that was an example where this is largely bullish. Now this candle has pulled down a bit here, but largely speaking, when you analyze it on the monthly, it's got 6.5. It's coming up against that. But it's just started this uptrend. So it's more likely to probably head a little bit higher up to here before it decides what to do. and the fact that it's now gone from a longer term downtrend into a longer term uptrend implies it's probably going to take a bit of a run a little bit further up. So the momentum is much more to the upside. And so now that I know the momentum on the monthly and the weekly is bullish, it really is the question now of taking a trade. The direction is clear. So my process has been, is the chart telling you what direction it wants to go in? Is the price action, if the answer is yes, then the next question is the price action relatively stable enough for me to predict roughly what it's going to do? Then if the answer is yes, then it becomes tradable. Then the question just becomes, where do I get in? So there's a couple of options here. There's really two basic options of entering on the daily here. The first one is if price retraces back to this level. Okay, that's a normal day-to-day kind of trading thing. Price breaks through a level, comes back to retrace. If it sets up, you can do that. Now, for those of you who've maybe never heard me say this, what qualifies as a rejection of this level is, as price comes down, we would get a bullish candle on the other side of this level of resistance, followed by price breaking. Then that would be your setup, and then the follow through would price breaking the high of it to the upside. And that's, ladies and gentlemen, that two-part process of the bullish candle and the following candle breaking the high of it is a two-step process, which is the market saying it has rejected that level. So that's one opportunity. The other would simply be price pulling back into the buy zone, maybe near the 6,000 level. So it comes back down to the 6,000 level, sets up as a bullish candle on the buy zone, but not off this level. And that is subsequently my opportunity to join the trend to the upside. Okay, so that's broadly speaking our bullish momentum. So we've got bearish momentum here as well. I've taken BT group. We can see here largely the price itself is very, very, very bearish, just running down. Price has been down this low before, so there's no reason why price can't potentially go further. We look at the weekly, and the behavior of the weekly itself is very stable. So there's a lot that price action tells us, that the stability of that trend is really telling us that price itself is a steady selling momentum, and so that's something that pro traders are looking for. If I'm going to trade, look to short a stock, I'm going to look for something like this, where it's got room to go, but also that its behavior has largely been orderly. So then there's another question here as well. And so there was a question there, would I wait for it to come back to that level before I took the trade? So I hope I answered your question there. There's two ways. Wait for it to come to the buy zone, but also if it hits the level, that's a double. That's another reason to take it. Should we look at the high and the close of the bullish candle? I'm not sure if I've understood that correctly, but I look at every aspect of the candle, absolutely, the shadows, the highs, the lows, every aspect of it. So I do include all of it. And so the beauty of this, if you look at this from a monthly perspective, we're not that overextended away from the moving averages. What I mean by that is this is a very aggressive move to the downside with quite a bit of a gap between that and the moving averages. By comparison, this one seems a slower angle by comparison. It's not falling straight down. It's got more of a steady move to it. When we look at it from the weekly, we're not that far away from the moving averages. This was quite overextended from the moving averages. By comparison, this one is not as far. And this is going quite fast. So the daily is moving quite fast, but the rest aren't. So this just kind of overall is basically saying that there's some potential for this to keep going. Okay, it's not completely out of control. So because the way that it works is price will start slowly, then accelerate, and then slow down. And if it doesn't really accelerate a lot, it has the potential to keep going. So that's one way of looking at it. So then this is important. So this one here is no real momentum. And there is so much information being held just in these three candles here. So there's a lot of information being held in here. First of all, we don't have a clear series of higher lows and higher highs on the monthly. Okay, we don't really have that. We've just broken the high of that, so we have a low and a higher low. So we've got a low and a high and a higher low. But these last three candles for the last 3 months have not done very much. And when we look at the last, 8 or 9 weeks of price action, it's still within a couple of hundred pips or even 100 pips or less, and has done very, very, very little. And so then when you look at the daily, it's not really a surprise. There's no clear direction. There is an uptrend on the daily at the moment, but there's a level of resistance. But overall, the point is that if we had to compare that to either of the two previous charts, then it should be now obvious to us that the either of the two previous charts I've just shown you would be more preferable to trade than this one. It just means come back to this one at a later stage. That's all it really means. But the monthly chart, you see, and it's beautiful because just looking at the monthly tells me that there's really not necessarily that much for me to trade here. So momentum can be derived. So in other words, imagine this. I was saying earlier that if you're trading the 15 minutes or 1 hour time frame, what real benefit do you get from the monthly? But just looking at the monthly here, this is not really that great. So this already makes me not even want to trade the 1 hour. And by looking at the daily, you can kind of see that there's just not a lot going on here as well. Also, characteristically, when we have behavior like this, price is very much justified in changing its mind because it has no clear direction and there's clearly no bulls or bears winning at this point in time. There's this constant battle on multiple time frames, and so price can go up a bit and then bears can enter and it can go down and then bulls enter and it goes up. So it becomes a rough place to trade, and its ability to change its mind, to look very bullish 1 second and then just lose interest and lose that momentum, even on a 1 hour time frame, actually makes sense because the bulls will attempt to push it up and then it'll fail. So in situations like that, you kind of just want to come back to it at a later stage. Either you'll have like a momentum build up, like a momentum expansion trade setup that's building up, and you'll see that pattern, and then that'll say to you, the pressure's building up, it's going to break out. But if you don't really see a crisp level where pressure's actively building up, then don't waste your time and just move on to other elements. Thanks, Michael. Let me just have a look at that one. So here's my quarterly. This is actually a quarterly one over here, and there's my monthly. Yep, sorry, and there's a weekly. Yeah. Sorry, it's fine. It's fine. The message is still the same. The message is still very much the same, and actually I knew it was dollar yen, so that's why. But yeah, so even here we could see if we look at the monthly now, we could see that we had a bullish candle and then it kind of gained a little bit of steam, but we still got to really get to this area. So we're not free and clear yet. And the quarterly actually was not giving us much more clarity either. Occasionally I will go up to quarterly to see if there's anything more interesting. And I'll show you, for example, on cable, quarterly gives a bit more of a picture of it wanting to continue to the downside. But there's not a lot of clarity with the euro. So thanks for that, by the way. Okay, so now the questions were, so a couple of things about trading currencies and stocks and stuff. And so let's talk about those for a second. There are some characteristics of these, and they are slightly different. So currencies, for example, it's very important to remember that there are two parties involved. There's two currencies, all right? So they're pushing and pulling against each other all the time. And it's very complicated. You actually have two parties with, in theory, other than the US dollar, you have parties with, in theory, more or less the same amount of power against each other in those different markets. So I'm just going to have a drink of water quickly. So this is something that makes currencies unique compared to anything else. There are two parties involved. Now, what that actually results in is that it results in range-like behavior being a very common attribute with currencies. It's it's more common in currencies. So I don't know what the actual statistical amounts are, but you could say, well, currencies range 70% of the time or 80% of the time. But that isn't true for stocks. It isn't true for indices. So it's important to accept this, that understand that currencies can trend, but long running trends are rare, but they happen. They absolutely happen. We've had some really nice dollar CAD trends. We can get really good yen trends. We can get really strong euro trends. That can happen. Just to be aware that there are two parties involved. And if we're sitting in the UK and we talk about Brexit and then the euro doesn't move or GBP doesn't move, everybody goes, well, that's Brexit. And if you're living in the US and the dollar doesn't move, you go, well, it's Trump. Okay, so euro dollar. So you have to understand that it depends what side of the world you're on as to how you read the move. So usually what I'll do is if there's a big move on euro, my first thing to do is to look at cable. And if there's another big move on cable, then it's not Brexit. Then it's chances are it's the dollar. And then I'll go and have a look at Aussie dollar and Kiwi dollar. If there's a big move on those as well, then it's the US dollar that's done a move. And so we have to be aware of that. Um, and so just, for example, if in the last few months we've seen the euro climb up and we've seen the pound climb up, and everyone is saying, well, the pound climbed because of blah, 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 because of Brexit, it doesn't really make sense. Whereas if the pound had done its own thing, if the dollar had weakened and the euro had strengthened, and the pound had weakened like the dollar, then it would have been as a result of Brexit. So it has to do something on its own separate from the dollar. The dollar is like 60% of the market, currency market. When the dollar says jump, the rest of the market says how high. So we have to understand that it really plays there's different multiple cogs in this market, but we have to be able to separate it. And the only way we can separate it is if, for example, cable looks bullish, is to go look at all the GBP pairs. And if every single GBP pair is looking really bullish, then we know it's the pound. And by the way, it's possible for the euro economy to strengthen and the United Kingdom economy to strengthen. It's possible for the dollar. They can all strengthen at the same time. The question is they have to strengthen against each other relatively. Okay, so they can all do that. It's not a specific type of thing. So there's another question here saying, do fundamentals come into it more with Forex then? You know what? I've kind of let the fundamentals thing go, and I'm very conscious here. I'm going to throw stuff at you, and I want you to kind of think about things and see how that helps you or doesn't help you or help your trading. I've kind of let the fundamentals go. I read the news every day. There's a lot of junk in the news. I mean, I'm looking. There's a lot of propaganda now about apparently the mood in the UK has lifted since Brexit, which I don't buy at all. And then apparently, people's incomes are doing better, which I don't really buy either. So there's a lot of stuff which is just not substantiated. If I deal with a lot of people at all levels in London, and if I'm hearing something via the grapevine that everybody agrees on, then I'm like, okay, that seems to be the state of play. Whereas if I kind of mention something and not a single person I know can relate to it, then I'm usually like, well, it doesn't feel right to me anyway. So my point of this is that I kind of discount fundamentals to do with the trading, but every now and again, I'm very interested when something happens. I'm like, okay, was that as a result of? I'll look at Forex Live as is my go-to one. ForexLive.com is very good for when there's a move in the market, and I'm like, where did that come from? Because there's no news announcements. Then usually Forex Live guys will go and track down what it was. Which is to say that I don't ignore the fundamentals. I just don't make my trading decisions around the fundamentals. So if there's a US election or a rate hike, potential rate hike, I won't trade around those, but that's because they can interfere with my trades. But I don't make a decision like, okay, I'm going to buy the pound because there's a rate hike, because that's never worked for anyone. And it's interesting because I have my partners in the fund are not the traders. They go raise the capital, but they are they're from the banking world, and it's amazing to me because they'll say to me ahead of the rate hike, they'll say, what do you think is going to happen? I'll be like, well, I think there's going to be a rate hike because they need to be seen to be doing something. I think a rate hike is probably a bad idea, but I think they're going to do it anyway because clearly we're making lots of this is our year for making really bad decisions. They'll make the rate hike and they'll go, well, I think the pound is probably very overextended. And the pound kind of just dropped, and the guys are coming back saying, I don't understand, because we got a rate hike, why didn't the pound go up? So it's interesting in terms of, I can go, look, it could go up, that is what it's supposed to do, but it is overextended, so it's weighted the wrong way, and the market knew the rate hike was coming, which means that they've probably positioned themselves in here. So over time, you kind of start to be able to incorporate what you see on the charts with what you think the market's going to do. You are able to find a way to rationalize it, which makes more sense because you kind of, your brain starts to put the pieces together a better way. And I think that just comes with experience. So you have to be more attentive with trade management with currencies because they can change direction. So when I say more attentive with trade management, I mean you have to consider the idea of taking profit, because you can go into profit You could be up 2% and then you can be stopped out because you didn't update your stop or because you didn't take profit. So understand the currencies are not obligated to do 3-to-1 or 5-to-1 moves. They can, but it's so random. It's not a very common type of thing. So I really, really am very attentive. I'm very quick to take my 1-to-1 profit, and I'm very quick to update my stop when I need to do that. I focus on the 25 most popular pairs, which I've chucked on the right-hand side for your reference. You'll see right down at the bottom, you'll see dollar SEK, you'll see the Danish kroner, dollar ZAR, the pound against the rand. Those are just extras at the bottom. And there's a few others up and coming. There's a couple of European currencies that are coming up. They've got the liquidity, they're there. But everything above that, from Kiwi CAD upwards, are the most regularly traded pairs. Even if you take out the Swissy pairs because you're worried about an intervention or whatever, look, if you could trade the Swissy pairs, you could trade it on the 15-minute time frame or the 1 hour. It's one of those things you might not want to trade at end of day or on the weekly basis, but you could certainly trade it short term. And at the moment, there doesn't seem to be any indication from them that they're going to interfere with that. So they usually kind of start to murmur about stuff, and then they give you a couple of months of heads up. So that could happen, but it's unlikely to. Anyway. Commodities can be seasonal. So gases and fuels can have trends that kick in at certain seasons. It's worth your while to read up about that, see what you can scour up about that. So commodities can trend. And by the way, when I say commodities here, I'm including everything. I'm including wheat, orange juice, cocoa, coffee, copper, all kinds of things can be seasonal, and they can trend beautifully. Like soybean and cocoa just had the most beautiful downtrends up until about September. Phenomenal, printing money. So the goal here when we talk about momentum is to find a chart that is clearly trending. And if you're not finding it in the currencies, you need to be looking at other markets. If I was only trading currencies now, I'd be making a big mistake. I have to be looking at other markets. They're all accessible. They're completely accessible. And so I'm looking for the trends, and they can trend very well up or down. And also they can often go through consolidation periods where they do nothing, and then just suddenly out of nowhere they start trending. But the point being is that they can trend really well. Like at the moment, gold and silver not really going anywhere, and that's fine because they really can trend. So it's just one of those things where I would check them once or twice a week, but I wouldn't obsess about it. I just run through my scanning. And liquidity shouldn't be an issue. Occasionally you might do something. Maybe if, for example, you're with a particular broker and you've got access to one of the something unusual like lean hogs or something, and maybe you're down on a 5 minutes and liquidity doesn't look good, that could be an issue. But generally speaking, most of these, for most people who have trading accounts of, let's call it 500,000 down to 100,000 down to 50,000, should not have any issues with trading those because you're not too leveraged anyway. Okay, so I'm keeping an eye on the time just kind of as I go through the questions. Are you guys finding this useful so far, by the way? I have charts I am going to get to. There are pictures involved. It's not just words, I promise. Okay, so this is a very good question. Will you have multiple positions on shares at the same time, even on the same indices without spreading risk? Yes, I will. Okay. Yes, short answer is yes. If it's a good trade setup, I'll take it. Okay, so characteristics of different asset classes continued. So, and the beautiful thing is I learn more as I go. So the more, in a couple of years' time, I'll have more information on this that I'll be able to, observations and experience that I can put into this. So indices, this is beautiful. Okay, we're either in a bull market or we're in a bear market, and trending is normal. So this is very, very important this is a massive lesson that I've learned in the last couple of years. It wasn't just about learning this about indices. It was about learning this about indices over currencies. Is that trending in these markets is very normal. Okay, it's less likely to range. When it's ranging, it's more of a consolidation before it either reverses or continues, and it's actually much more likely to continue than it is to reverse, but not guaranteed, but just more likely. So not all indices are equal. So I have to be selective. The DAX is phenomenal. The liquidity on the DAX is way higher than the FTSE. This is something that I learned recently, that there's a bizarre kind of thing in the UK to want to trade the FTSE. And the FTSE is junk by comparison to other markets. Simply put, in my experience. So when I'm telling you stuff here, I'm not really speaking for Trade with Precision. I'm speaking for myself. I may trade the FTSE, but it's really low on my list. That's why it's on the last one here. I focus on the smoothest and strongest trends. I'm going to show you some of those in a moment. So I've got to keep an eye on the time because we have 16 minutes left, and I've still got one or two more slides I need to show you. So the DAX is phenomenal. The liquidity on that is insane. It's like, to me, the DAX is as liquid as some of the biggest US ones. It's just so powerful. There's the Hong Kong Hang Seng. There's the Nikkei. They're also there as well, so they are tradable, but we can have a look at those ourselves. But the Dow, I mean, the Dow is phenomenally massive. It's an thermometer of the economic well-being almost of the world, simply because the US is so representative of the economy, and the Dow is the thermometer for the US. So the S&P 500 is beautiful because it's 500 companies from all different sectors. So it's a great, again, a great indicator of the health of different sectors around the world. The NASDAQ is technologies. So there's just, and the Russell 2000 is not even on the list. It should be on the list. The Russell 2000 is mid-cap, smaller companies as well, but there's a bucket load of these. And honestly, if I had focused on these, I probably would have made a lot more money a lot faster if I had just focused on these, and they're very tradable. And you'll often hear that traders in the 80s and 90s, when you hear about traders making their millions, they didn't make it on currencies. They made it on stocks. They made it on all this stuff because this stuff trends like crazy. Currencies, let me explain why currencies are touted as fantastic. If you think about it, up until currencies really became available, you could only trade your market when it was open. So you were limited to the hours that the market was available. And suddenly currencies became available and they were 24 hours, 5 days a week. And they were also quite liquid. So people would have definitely have entered that and they would have been touted, just like binaries are being touted now. So Forex was being touted 10 years ago, and now it's binaries. But it isn't better. I mean, to me, I'm finding the old historical stuff is really where the big money, for me at any rate, is going to be made. So if anyone cares, I think I did 14% on just last month, was 14% on just stock trades and indices. End of day. And that's 1% per trade. Whereas when I'm trading currencies and trading for clients, that was on my personal account, trading for clients, I'm doing 0.5% or less, and the returns are more like 2 to 4 to 5%. So just so I'm not just throwing it out there, I'm saying the stocks was a lot more aggressive, and but the other stuff is a lot lower down and a lot smaller. So stocks, like indices, they're not all equal. I focus on the strongest, cleanest charts only. Gapping, liquidity, and price are very relevant here, so being very selective about that. And not all great stocks can be traded on smaller accounts, meaning some of the stocks are just too expensive. They're just the way that my brokerage account was structured. I can't go smaller than a certain amount that I need, and so I have to pass on a really great trend or a setup simply because I don't have the budget for it. It's going to be like 3% risk, and I can't really do that. I know you've typed in questions. I'll get to those in a moment. And some platforms allow for users to create scanners to help. So I'll have a look at that as well. So, excuse me, let me go and have a look at the questions and then we'll carry on with this. So there's a question about best way to trade indices as futures or ETF. I kind of think I mix it up. I like the future stuff, is pretty good. It really is. On the whole, yeah, just investigate that for yourself as well. Will I go either long or short regardless of the direction of the index in which they are quoted? Will I go either long or short regardless of the direction of the index in which they are quoted? I've done a couple of short trades, but I just stopped doing short trades after a while because the market is just bullish. So basically, I'm just going to stay that way until we eventually shift, which just means my bias is looking more for that. So what I've done here, this is actually quite cool. These are all daily charts, and they're from across the board. So I've got crude oil, I've got NASDAQ, I've got the Kiwi against the dollar, I've got General Electric stock, I've got Visa, and Intel. The point of them is they're all roughly the same. And yes, will I trade Am I, will I trade two different stocks going in the same direction? Yes, I will. So I don't have a problem with adding them on, because interesting enough, the indices and individual stocks have some different behaviors to them. So trading stocks as well as indices is fine. This was really interesting to me, the General Electric one. The trend was clearly to the downside. And the beautiful thing is, if I had traded that gap down, and I hadn't traded it, but if I had, that gap down would have yielded, can you imagine, probably about a 6 to 8% kind of return. And the gap down is in the direction of the trend. Okay. And in situations like that, the gap is very likely to be in the direction. The reason for it is the trend itself is so stable that the gaps are usually in the direction of the trend. If the entire stock is unstable, the gap can be in any direction. But when the direction is very stable, gaps, they'll tend to favor you. So that was very important. That was kind of cool. Now, this is very important. Daily charts, because I'm only looking at that, it's much easier for me to scan through a daily chart and just go yes, no, yes, no, yes, no. And I wanted to highlight a couple that I would pass on as soon as I saw them. So the first thing here is, this is euro yen, and it doesn't really matter what it is. The problem I have is that even if I saw this move up, I've got a very short distance before I can take any profit. So it's not just that it's kind of where it is. You can see it's starting to move up, and it's probably going to go up to that level. But then I have to deal with that. So basically, that's not worth my while if I have something better to trade. These are so classic. So pound yen daily is just 4 or 5 days in the same place, not really going anywhere immediately. This is just a mess because of this massive spike and down. This whole collective behavior of the last 10 to 20 candles is a mess, and that's the JSE, Joburg Stock Exchange. This is just immediately a mess. So you'll see there's something that they all have in common. They're all right on top of their moving averages and completely entangled. And you look at about the last 8 candles, there's no clear direction here at all. That's silver. Then looking at Singapore dollar, no clear direction. It's lower highs, and if it breaks that level, it's going to move down. But currently there's nothing for me. And this is exactly the same as well. This is the pound. There's just no clear direction. So as soon as I arrive on a daily chart and it's completely on top of itself and the moving averages, I just immediately move on. There's no reason to look at any other time frame. Just let it go and move on, because there's nothing below that. There's nothing on the 15 minutes of that time frame. There's nothing on the weekly. Just let it go. Come back to it tomorrow or the next day, but just move on. So the speed at which I can look at a chart is probably less than a second, and I move on to the next chart. So these are charts that are just not completely tradable. If we go to these ones are, they have a direction. They may change direction, but at least they have a direction, as opposed to these ones that will change a direction and they have no direction. So it's kind of, that's the case. Then benefits and takeaway ideas before we go to the platform, because again, keeping an eye on the time, we've got 8 minutes left. The benefits are minimal news impact. So I do want to watch for things like earnings releases, and that's fine. Non-farm payroll or rate changes are big, FOMC. So there's different devices that will move the market today, because the kind of financial system is still a bit shaky. So they're resorting, like they're not doing QE the same way per se, but they're using rate changes to try to curb inflation, or they're trying to do different things. And so those are the things that are likely to kind of just create market things that will create maybe a bigger daily bar. So that could impact a trade. To some degree, the brokers have that control over slippage, but there are certain situations where it's outside of the brokers and the bank's controls when you have something like a flash crash. But the beautiful thing is, trading end of day means that I can largely discount the news. The only stuff that I would really keep an eye on for myself is something like a rate change or FOMC or Bank of England type of announcement, where it's very high level, where the market's on edge and they're paying attention to that one thing. But it does mean I can pay less attention to the news. I don't have to worry about it so much. There's a better ratio of spreads to position sizing, meaning that our spread, our that we have to include, plus our entry and our stop loss, it takes up a massive percentage of our trade. So if we're trading a 1 minute time frame and our spread is 2 pips and it's a 3 pip candle, we might have 2 pips on either side, and suddenly it becomes the risk reward starts to get impacted. On the daily, that 2 pip difference is nothing on a 60 pip candle, for example. Now, Smaller candles can be 25 pips. You can get a 25 pip daily candle, which is perfectly acceptable on a small account. Where people stress a bit is when it's a 120 pip candle. Okay, but that's a large candle in my opinion. So that's something to keep in mind. Gapping has a lower impact, so that if it does gap on the daily, sometimes it'll gap. The stocks that I was trading almost always gapped in my favor. Okay, so and if that gapped against me, they might gap it while I'm already in profit, and then it gaps back down, so I'm at break even. And if it gapped against me, it was never really panicky because I was making relatively good returns. So the stocks would yield 2 to 1 or 3 to 1 or 4 to 1. So it not a problem, and I would select charts that don't gap anyway. Then there are the 30 to 60 minute fixed scanning and trade management time. So basically at 4:30 I scan to see if there's any UK stocks that I want to place orders on, and then I can scan again in the evening before the US closes to place my orders. So I place the orders before the market closes, and it can honestly it could take me it can take me minutes really to do all of that. It's less emotionally turbulent, so it doesn't mean that a losing trade doesn't hurt. Sometimes I go, oh, okay, I'm down. I might be up. So interesting. In the first month, the beginning of last month, as I went, I was down 4%. Almost right out the gate, and that was kind of a bit like, oh well, that's not really cool. But actually what I realized was that I had a lot of open trades that were in profit, and if I closed them I'd be up 4%. So what happens is the losing trades hit their stop losses relatively quickly, but the winning trades keep going. So it was just quite interesting as to how that goes. So you still have it, but you're not sitting there on edge throughout the day at your computer stressing and sweating, and you can't. Someone says you want to go get a coffee and you can't because you're distracted the whole time. So that isn't the case. And I found the returns can be more predictable, meaning that I'm largely confident I'm going to make money every month. Whereas I do think that if I was trading intraday, occasionally I can have a really bad day and I'm kind of given 3% back to the market before I kind of know what happened. That sort of thing can happen. And so for me, I just found that it's less time consuming. And scanning, as I said, was much faster just by checking the daily charts. So, but I had to be aware of spreads widening around the close of daily bars. So sometimes um, when markets are the daily bars are being closed, the spreads can widen quite a bit. And when markets are opening and closing, that can be the case. It's not worth obsessing about the news drama about Brexit and Trump with regards to trading. All I mean by that is it's interesting to read it, yes. And are we close to World War III? Well, I don't know. If we keep poking North Korea, something could happen. Who knows? And I say we because it will impact all of us. So let's be real about this. But also, I don't have to obsess about it to do with my trading. I focus on price action first, and I don't obsess over momentum indicators. This is another thing. The MACD and RSI, think of it as you're driving your car. So when you look through your windscreen, that's what you see on the charts. And when you look down at your dashboard, which is your speedometer and your petrol gauge and everything, those are the momentum indicators. Okay, so you don't drive your car by looking down at your indicators. You drive by looking through your windscreen. And so this is very, very important, and not obsessing about that. A lot of people get on the chart and they look straight down at the momentum indicators. And actually, in that case, you should just get rid of them and just focus on price action. And the point here is to say that divergence happens a lot more near key SR levels than anywhere else, meaning that the whole reason we can identify support resistance levels at all is because that is where price has changed direction. Okay, so that's where price has changed direction, and so that's where divergence is likely to occur. So usually, once I've identified my key levels, I don't stress about divergence unless price is really overextended. And so what could happen is price could be moving between two daily support resistance levels, and it's very overextended on the 15-minute time frame, and therefore it's a bit divergent maybe. So it'll take a breather, but it'll carry on the daily. It won't have a problem. So that's the kind of common sense. But just what I mean by that is divergence occurs around the key levels, so we would expect it to come in, and that's why it's important on the expansion strategy. Okay, so there's some further reading, and what I'm going to do is I'm going to dump this into the. Can I do this? Oh, okay. Well, these are some further readings if you can snapshot this. Basically, Investopedia, how the S&P 500 and Russell 2000 indices differ. What I'm going to do is I'll copy and paste these into the questions box for everyone. I'll actually do that now, so there's no real problem with that. Let's just go here, go down to these slides, and then quickly do this. Can I copy the link? So let's do that, and I'll just paste that in. It's nothing magical. It was just more interesting that I thought everyone else would like to see. So it's going to be like that, is it? Why is this all? There we go. Let's try this again. There we go. Do that, and then that. And then that one. And then I see that we are now kind of on the end of that's the last slide, and we're kind of on the end of our time. And all I really wanted to show you was just having a look at, so this is if anyone's interested, I mean, I'm using multiple platforms because of different clients and different funds where they lie, but I've been really, really enjoying Pro Real Time. So this is why you see me using it, because I can have different layouts. So for example, I just hit the flip of a button and I've got this layout here, which is kind of a weekly and a monthly kind of trend-based indices layout, where I can kind of look at this. And I'm going, the market's bullish, and this is the quality of the trend that I can trade. So as soon as I get pullbacks, I can start to look for entries, and these are really, really nice, clear trends. So this is what I talk about when I say really great trend. If I look at the French CAC, it's not as clean as the S&P 500. If I look at the Nikkei, it's got the strong rejection candle, but it's still relatively good. If I look at the Hong Kong, this one's not bad either. This is the Hang Seng. Let's look at the Dow. The Dow looks very good. So these are very, very, this stuff goes on for years. And when it's heading down, we're in a bear market, we could trade that. So to me, I always see this actually as a bread and butter owner. This is really, really, really good. And this is the way that these markets should always, always be. So the platform that I'm using is Pro Real Time. You'll see it up here. I just didn't, as a courtesy, excuse me, to my clients, I didn't log into a client account, but Pro Real Time is the account. It's very cool. It's true. I went through IG Index, but different brokers have it. But I was using eSignal before that, and TradingView is phenomenal. So TradingView is actually the same thing, and it was me that introduced Trade with Precision to TradingView because it's phenomenal. I'm using this because I'm doing some more advanced stuff. So if I go to this page, for example, here's my end of day analysis, so I can look at different markets to see how they're looking. And then if I go to, let's see, this one, so this is more intraday trading. So this allows me to do 30 minutes, 30 minute, 1 hour, 4 hour, 8 hours. So I can kind of see the momentum of how these different markets are doing. So what was the trade we did the other day? It was dollar CAD, was it? Was it dollar CAD? No, that was that one there. And then there was was it Aussie dollar? I forget now. Aussie dollar. I forget what the trade was. Yeah, it was this one. Sorry, that one there. And then we pull back up and look at this. Look at that move down. Anyway, that would not have been tradable unless you had been getting in on a higher time frame like there. And then finally, I thought you'd be interested. So I built a bit of a scanner. This one's kind of cool. And so I will do, because we've run out of time, I will do either a separate kind of video on this for the Traders Lounge, where I'll just talk about how I want to do it with basically eSignal had the ability to do it. This has the ability to do it. And I think TradingView has the same ability to do it. There's a way to build a scanner. And the scanner just is quite straightforward. It allows you to say, well, I want my 50 moving average above my 200. I want my 20 above. It's not for programmers. It's for people like us who are not programmers, and you can kind of get it to scan stuff. And so I use it to kind of scan for stock trades. And you'll see as I go through them, there's like this one I wouldn't trade because that you could tell by the price action it's not really that great. This is actually not bad, and even the gapping is quite small, so that's not so much of an issue. Some of them look phenomenal. You could tell, like this one I wouldn't trade at all, and this one's lovely. So this is very, very nice, And so these are kind of stock trades, individual things, but always in the direction of the trend and always looking for that supporting stuff. Fibonacci, round numbers, support resistance levels, previous highs, always, always, always the same stuff. So I thought I'd show you that kind of stuff. And then you can see some of these, like some of these trades just work kind of really, really, really well. Um, So I thought I'd leave you with that one. But I could talk about this for another hour, and we don't have the time. So I'm going to leave you with that. I really just wanted to introduce you to that concept of considering the idea of trading end of day. But if you're going to do end of day, you have to. If I was going to do it now, I have to include indices and stocks and commodities as part of that. The currencies would become a quarter or a third of the trades that would be done. There are often end of day setups on currencies, absolutely, maybe 1 or 2 a week, maybe. We can also get patches where for 2-3 weeks it's difficult to find currencies that are trending because they're a bit tricky. But certainly once I include indices and stocks into that, the number of trades goes up, maybe 7 or 8 a week, but the returns on the other ones are quite good as well. So this is to give you an introduction to kind of to where we are. Yes, so TradingView. So there's a comment here saying I use TradingView. I do enjoy it. It's very user friendly. It's very interesting because it's got a lot of potential. It's going to go places. What makes TradingView unique is that prior to TradingView, you had to subscribe to something like eSignal for hundreds and hundreds of pounds a month to get access to certain data. Whereas with TradingView, it's an easy to use platform, and you get access to, for a much smaller amount, you can get access to um, fewer, lots of markets. And also setting up these types of scanners should be relatively easy. So it is a work in progress. I believe that the coders are going nuts, and every few months or even every month you're going to get massive upgrades, and you can actually put input in now as to what you would kind of want. So I think there's a lot of potential with that. So yeah, so ladies and gentlemen, I think on that note, we've run sort of 6 minutes over. There was a lot of information in this. Again, just to recap, that this was largely about considering the idea of multiple markets, end of day, but always focusing on the quality of the trend and on the quality of the trend, and understanding that trade management can make the difference. If I didn't update my stop religiously, or update my entry potentially, then I had, it would impact the quality of the results of my trades. So that was trade management, and then just trying to give you a bit more of a sort of a higher level exposure to what my average kind of, you can sort of get a sense of what I probably am doing every week. And sometimes I'll have time to do an intraday trade, which I did this week. I had a couple of trades I was able to do, so I did those on the Traders Lounge. But this for me is like, if I picture myself a year from now, and I haven't played golf in years, but this is an example. I could do this probably for an hour a day, and then potentially make some really, really good returns on my personal accounts as well as client accounts. So anyway, ladies and gentlemen, I think I want to leave you with this. I'm going to wrap up the webinar. I want to say I hope you found it useful. I hope you found it instructive, and it was a pleasure. And I loved all the questions. And we're going to be doing this more frequently. I think the lounge is a fantastic. It just feels like there's a much easier connection between us and you guys, and it's easy for us to post stuff, so it becomes a lot faster. And that's it. So let me wrap up the webinar. Wish you a wonderful week's trading. And yeah, if you enjoyed it, give some feedback to Nick and Nikki and Ryan. They always like to hear back from you about these things. If you enjoyed it or didn't enjoy it, it's fine. We're here to give you the kind of information you need. And yeah, and again, enjoy your evening. Thank you very much. Yeah, good to see all of you. I love the fact that I know half of you as well. So very good. I'm so glad you're all in this. And I'll see you around. No, great. Thanks, guys.